I would like to introduce our topic today, Nonprofit Insurance 101, what nonprofits need to know, and bring on our two very well-versed and spectacular panelists, Colleen and Amy from CalNonprofits Insurance Services. I'll let you all take it away from here.
Thank you, Robert. Welcome, everyone. Today, we're diving into the essentials of insurance for nonprofits. I think you'll find information here, no matter how long you've been involved with the insurance, how pricing works, and what's happening in our industry. The goal of this presentation is that at the end of it, you will have a high-level understanding of how these coverages work together and cover various aspects of your organization. We are skimming at the 10,000-foot level because we could spend an hour on any one of these coverage topics. I'm Colleen Lazanich. I'm the CEO here at CalNonprofits Insurance Services. And we have Amy Newman-Rangel, who is the Senior Vice President of our Property and Casualty team, presenting with me today.
Good morning. Good to see so many people. We've got representation from the Bay Area. Whoop! I'm in San Leandro and all the way down to Southern California, Big Bear Lake. We've got a lot of people that are attending. So thank you so much for your interest. It really drives what we're doing and tells us that we're on the right track for the material that we're presenting. So good to see you all.
Yes, and our agenda for today is these high-level insurance concepts. What are the customary coverages for our business? And we have common insurance terms. That is really going to be a handout that we that Robert will drop in toward the end of the presentation, and then we'll have some time for Q&A. As I said, we could go way in depth on individual questions about coverages. But we have a lot of material to cover today.
Very good.
So really, we want to start out with the idea of what is insurance. And basically, insurance is protection for you. It is one way, not the only way, and we'll talk about some other ways of transferring risk away from your organization. Anything we do has a risk associated to it. It does not get rid of the risk, but it can help reduce that overall cost because you would be basically exchanging a premium, which is a smaller amount, for the potential of a large amount if there is a loss. So in nonprofit and in other businesses, but in nonprofits particularly, there are three main areas where you face risks and where you need to have insurance. These, requirements come from three areas. One is statutory. The state law or federal law say you have to have this kind of insurance. Those examples are workers' comp and auto. We will be talking about all of these coverages in depth. Contractual. Contractually, Robert, your calendar just popped up.
I love technology.
Contractually, from vendors, from funding sources, you enter into agreements. Venues would ask for your insurance. Lots of ways you take on risk through contracts. And so they will also determine often what coverages you have to carry. And then the exposures that just exist in real life. So for example, directors and officers and your general liability and improper sexual conduct through tort laws or other reasons that you need to or should insure these risks to avoid paying for it. Because as we said, it doesn't get rid of the risk. If you don't insure it, you could end up paying for it. Your organization could. I want to spend just a minute talking about contractual liability as nonprofits, especially some of our smaller nonprofits. They just sign contracts to get funding without necessarily negotiating or looking at those contracts. And sometimes they're taking on risks that may not be insurable or transferable to them from the entity that's trying to transfer risk to you. So, you should look at those indemnification agreements, insurance requirements. There are some organizations that can help with some pro bono legal help for you, but you do have some power in negotiating or looking at those contracts. And we know sometimes it's easy to just take them on because you need the funds.
Next slide.
Yes. So what is risk? Risk is the chance of loss. Some people compare it to gambling. Hey, I'm going to put my ante down for, $2,000 for my premium. And, that's my gamble, but it isn't a gamble because risk is actually the chance that you'll have a loss. When you're gambling, you have a chance of winning and you have a chance of losing. And really, when you're talking about risk, it's what you could potentially be losing. And I had mentioned earlier that insurance was one way of handling risk. There are other ways of handling risk. You can avoid it. You could choose not to do the thing that is bringing you that exposure or that risk. You can reduce it. You can mitigate the risk through safety equipment or making sure your procedures that you're doing a safety inspection on the premises so there won't be a slip and fall. There are lots of things you can do to reduce the risks that you have. You can transfer your risk to someone else. That's what you're doing with an insurance contract. So your insurance contract is transferring that risk to the insurance company, the risks that they're willing to take on in the insurance contract. Likewise, you can transfer it to another entity through a contract. And that's what these funders and other contracts that you sign are transferring to you often is risks that they might have otherwise. Or you can accept it. And accepting risk means that you're willing to pay for that. So some things are not insurable and you have to choose one of these other methods, or you have to choose to accept it. And typically, if you're accepting a lot of risk, you should set up a fund to potentially pay for that risk. I mentioned transferring the risk to the insurance company. It is a contract. Your insurance policy is a contract between your organization or you as an individual and the insurance company. Your broker is not a party to that contract. We help you get the best terms and conditions that we can in your insurance coverage. But really, that contract is between you and the insurance company. There are standard policies and non-standard policies. Sometimes you'll hear people say it's an ISO form or it's a standard form, which means most companies use that same form and there's not really any negotiating power to change those terms and conditions. Other types of coverage have a non-standard form, and each company's form is different. So you have to carefully review those forms. And that's one of the services that we provide as a broker is to look at those forms and tell you what those differences are. So your directors and officers, professional coverages, sexual abuse and molestation, cyber, all of those policies are different from carrier to carrier. They may even call the coverages different things.
Mm-hmm. I like this slide.
So this is really just showing how it works, because there's a lot of times people think that us as the broker, that we're the one providing the insurance, but we're not. We are here to be your best representative to all of the potential places we can get you insurance in the marketplace, and to help you understand what those coverages are that you're purchasing. So A, you're not purchasing more than you need, and B, that you are getting what you need, because there's a lot of times where we see some really big gaps in coverage between them. So we're advisors. We're your partner in trying to get you the best coverages. We go out to the market to get you coverage from a lot of places. It could be a direct insurance carrier. It could be that we're placing that through a wholesaler because they only work through wholesalers, or their coverage isn't admitted in the state, or it's a specialty line. And then there's also risk retention groups that kind of operate as insurance carriers, but the group is retaining some risk in there. All of them have reinsurers behind the scenes, and those all the insurers I can think of have reinsurers behind the scenes. And a lot of when we talk about the marketplace and what's happening in the marketplace is the constraints or limitations or capacity of the reinsurers that they place on the insurers and risk retention groups. And all a reinsurer is exactly what it sounds like. They take part of the risks that the insurance companies have taken in the insurance contracts and say, hey, if your losses exceed $100 million, we'll pay for them. But you have to still comply with our requirements or it wouldn't be subject to this contract over here. So,
Good explanation.
yeah. And Amy, I'll let you talk about the roles and responsibilities of a carrier versus broker.
Gosh, I hope I know this information. So, as Colleen mentioned, the relationship between you as a nonprofit and CalNonprofit Insurance Services, we're your broker. So, if we look at the right-hand side, looking for a broker, you want to make sure that you have someone that is really knowledgeable in this space, not just in insurance, but what your organization does, because that every organization or industry is different and the coverages that apply can be different. So you want to make sure that they're familiar with the insurance carriers that are going to be able to write your business, that have the right forms and coverages, that are going to provide you transparency, that are going to be able to give you updates on what the market is doing, and that they can provide you the service and support related to whether it's, you're getting a new lease, and you will need a review of that lease or a contract, or you need assistance with, claims process, workers' comp claims or general liability claims, D&O claims. And then that broker helps you get the best carrier. And when we say carrier, that's another word for insurance company or market. We use those words interchangeably, but you're looking for a market, or your job is for a broker to look for a market that is going to be experienced in that area, that they have strong support either in loss control, which is what we use, the word we use is risk management assistance, and that they're going to be responsive from a claims standpoint. And really important is their financial strength. As a broker, we do not place any insurance with a market that is less than an A- rating, which is excellent. You can go up to A plus, but when there's a downgrade, we let you know, and then we have to move coverage. So we're always making sure we're doing business with those that are solvent enough to pay their claims. This is a really busy slide, but
It is
but
a really
these are.
busy slide. Yeah.
Yeah, this is a busy slide, but these are the highlight of the coverages that we were going to talk about. Primarily, we've listed them in order of generally what you see from when you start out as a nonprofit, you're just getting started, all the way down to when you have a fully robust program. And then there's some other coverages to the side that are ancillary that can always be added in.
Okay, so one of the first coverages that a nonprofit would have, and actually one that we see isn't always put into place first, is your directors and officers or nonprofit management liability. I know one carrier has just renamed this coverage to be board and executive liability. So it comes under a lot of names, but really what the directors and officers liability coverage does is covers the decisions made by your board of directors and other covered officers. And these are these are the decisions that are made that could be regardless of the general liability, like bodily injury and professional services that are provided. These are, decisions, governance, those types of items, including, the formation of audit committees if required by law, what you are telling the IRS, all of those things are covered by your directors and officers liability. And when I say decisions, it is actually purely the decisions, not whether that decision was right or wrong. It's the fact that a decision was made or not made. So we saw during COVID, for example, that some claims came to nonprofits because they made decisions to shut down services when they, and didn't get exempted from it. We saw other nonprofits that because they didn't shut down, they had they made the decision not to shut down, they had claims made against them. So it is really important because nonprofits have more claims against them than other private corporations. Statistically, it's something like 60% of nonprofits will have a claim made against their D&O or management liability policy.
And because no
Um,
other policy covers that, the D's and O's are personally liable. Your assets as an executive director or board of directors, your personal assets are at stake. So it's important to carry this coverage. It also attracts, if you're looking for people that you want to have served on your board, they're going to be looking to be indemnified or covered by a D&O policy.
yes.
So we have another claim example about
Wait, can you go
mis
back one, Robert? Yes, thank
Mis
you.
so just misuse of grant funds. So if a nonprofit board was sued by donors because they misallocated restricted funds, and so the D&O coverage paid for the defense and the settlement costs in that example.
And the other thing is that often, and this is one difference from like general commercial policies, is it can include your employment practices liability and fiduciary liability. There are other types of partnerships and stuff where those coverages are written completely by themselves. But in the case of nonprofits, most of our policies will include employment practices and fiduciary, and we're going to talk about those for just a minute too.
We should highlight too that pricing is we want to talk about each coverage and how you can understand where the pricing comes from, which is it's going to depend on financial stability and it's going to depend on board composition and if there's been any litigation history.
Yes. The employment practices liability is often written in the package. Like I said, it can be written outside of the management liability package or the D&O policy. If written together, it can have shared limits or separate limits. So that's important to know as you look at the policies. Even when they're written on the same policy, they can have completely separate limits, which is better coverage than having a shared limit for the both. The employment practices liability covers those things that are employment practices. So defensive allegations of wrongful termination, discrimination, harassment, including from third parties. And the biggest thing is that you can get an employment practices liability claim from volunteers. And so there's often nonprofits will say, well, I don't need the EPL coverage because I don't have any employees yet. But if you have volunteers, we have seen a discrimination claim from a volunteer. We've also seen wrongful termination. I was not allowed to continue to volunteer for an organization. So
Wow.
the important thing there is that it's providing the defense for those claims. Something that's getting harder and harder to get in California is wage and hour. When wage and hour coverage is there, it is defense only because if you fail to pay wages as you should have, that's not a coverage. That is not something that can be covered by your insurance company, but the defense of that could be covered and it would be a supplement of your other limits. It is becoming frequently or more and more frequently hard to get in California. It already was
Mhm.
somewhat difficult. It is now even harder. And that's primarily due to some of those other issues that we've talked about, like in the overall marketplace, such as PAGA claims and some of the other things that are happening in our litigation in California.
And something with that wage and hour, and an EPL, we call it EPL in general, is that mere allegation triggers defense. And so because the insurance companies we're so litigious in California that the insurance companies don't want to be involved in every single claim that's made. They have raised the retention, essentially a deductible. So where we used to see it, maybe 5,000, 10,000. New minimums are coming up, especially for larger organizations, for 50,000, 75,000. And so that's one way for the insurance company to reduce some of that exposure. But the pricing will depend too on employee count, turnover, and then also best practices around discrimination, termination, and whether there's support in making informed decisions when you are going to terminate.
Um, Fiduciary liability. This is also provided often, if asked, on the D&O policy. Also can have separate limits or conjoined limits. It is coverage for defense and settlements related to mismanagement of benefits plans. It is not only the 401k plans, it can apply to other employee benefits. And if you do use a third party to manage your benefits plans, your organization could still be liable for allegations of failing to maintain or offer those benefits because the benefits are paid. You act as a fiduciary when you take the contributions from the employees and pass them on. So, Amy, I think you have a claims example for this.
Yeah, so there was a nonprofit that failed to transfer the employees' contributions to the retirement plan on time, which caused investment losses. And so the fiduciary coverage paid for, again, the damages and the legal fees for that. There's also, if you don't disclose appropriately or timely, because fiduciaries, if they fail to notify retirees of, like, for example, a blackout period, that can result in a lawsuit and settlement. Pricing also is dependent on number of enrollees and participants, either from a benefit plan, or you don't have to have a 401k plan in order to get fiduciary, because it does include the benefits portion as well, failing to administer timely or at all. It's generally an inexpensive coverage and generally without a deductible.
And often overlooked.
Often overlooked, yes.
Yeah. General liability is the next foundational coverage. So, we say, do you know, because often this is before they've even started operations. A nonprofit will incorporate, and then they need to get their D&O coverage. And then the next one would be their general liability. And this is covering operations. This is what you're doing, bodily injury and property damage to these third parties, not your volunteers or employees. It usually includes personal injury, advertising injury, medical payments. Medical payments on a general liability policy can cover your volunteers, and we'll talk quite a bit later about accident insurance is often less expensive and can protect your general liability policy from claims. And you can include employee benefits liability, which is different from both fiduciary and the employment practices liability. The limits provided on an annual occurrence in aggregate, typically, it is on an occurrence basis. So policies, and this is true of all these policies, can be written on an occurrence, which means the claim occurred when the policy term is, regardless of when the claim is made, versus a claims made policy, which some of the coverages are commonly written on a claims made basis. A claims made policy means the claim has to occur and be made during the policy term or any retroactive period that's listed on the declarations page. So there's some extra steps you have to go through when you have a claims made policy.
It's a way to limit their exposure, and so you have to be aware of it and report it within that time frame.
Yes. And you can get higher limits on this. Some policies can be written on a 2 million per occurrence and 4 million aggregate. Others, you need to secure an umbrella or excess policy if your limits need to be higher, both because you have assets to protect or because contractually, which is what we more often see, you're required to carry higher limits than this.
Since general liability is covering property damage and bodily injury to third parties, a common example of a claim is, a client being in, let's say, a food distribution event, and they slip on a wet floor and they break their arm. Then they would have the general liability policy, the medical costs, and legal defense covered under the general liability.
And we've seen in this last year that the social inflation and litigation trends have been pushing this up, as well as carriers not willing to write in California specifically. So that's been changing. And the pricing factors for this can be anywhere from revenue, square footage, the number of students or participants. Yeah. often written, these two coverages can be written as endorsements sometimes, depending on the carrier, or they can be written standalone, but they are really common on nonprofit, less common outside of the nonprofit arena for unless you are in certain professionals like lawyers and such like that. But professional liability and sexual misconduct or sexual abuse and molestation. So professional liability is often referred as errors and omissions also. And this is really to cover errors made in providing or failing to provide professional services. Now, a lot of nonprofits say, oh, I'm not doing that. Well, there's this nonprofit coverage called social service professional, which is when you're providing services of any kind, whether it's advocacy or counseling, teaching, there is some professional exposure that you can be held to where person wasn't damaged by bodily injury, which would be covered by your general liability. They're damaged in some other, or they have some damage in some other way. And so because you either provided a service incorrectly or you failed to provide the services that you promised that you were going to provide. And so that is where the professional liability comes into play. The sexual abuse and molestation, sexual misconduct, improper sexual conduct, there's lots of words for this coverage. This is covering the bodily injury due to sexual or physical abuse against third party, typically the clients, but it can be other parties. This coverage is commonly written whenever you have vulnerable adults, and that would include the elderly, developmentally disabled, children, youth, any of those types of organizations. And I mean, there's been a ton in the media about these claims, after school programs, even camps that could be provided. So, that bodily injury is excluded under the general liability because it's considered an intentional act by your employee typically. And so intentional acts are excluded. If one of your employees goes and punches somebody, that's going to be excluded. They have their personal liability for that. There's other coverages. But if that's why it has to be given back through an extra coverage.
And some good claim examples that bring that home is from a professional liability, and we talk about counseling. So you have a nonprofit, mental health center that provides incorrect therapy guidance, which leads the client to harm. And so that organization is sued for negligence. And then the E&O picks up the errors and omissions, or professional liability picks up the legal fees and damages. Or if maybe you're in the grant administration process and you're evaluating who you're going to be giving money to. And in one case, a nonprofit foundation was sued after the grant recipient alleged the foundation had mismanaged the grant review process, which resulted in loss of funding. And so that nonprofit incurred legal defense. The nonprofit that was sued had to file the claim and get defense costs and settled for the damages. I think claims examples for sexual misconduct, I think it's pretty self-explanatory, but that coverage is that claim is example as a staff member at an after-school program is accused. And that's the other thing is it just needs to be an allegation. It's why these things are so expensive. A simple allegation triggers the defense coverage. But they were accused of inappropriate contact with a minor. And so that nonprofits faced the lawsuit for negligent supervision, and that resulted again in defense and settlement costs. So for those coverages, generally the underwriters are looking when they want to price this is usually based on revenue or the services provided. Are there any warranties made or contract, what kind of contractual agreements are you entering? And also if there's any, past history, claims history. And And we are seeing reduction in these limits, or being underwriters are being carriers, and the reinsurers are being much more conservative on giving out professional abuse. We used to be able to walk in and say, "Hey, I want $1 million abuse policy," and some carriers are saying, insurance carriers are saying, "Well, we want to see a contract in order to honor that." But it's not just based on you wanting to be more comfortable with your limits, but having a contract require those limits.
Yeah, and often now we're seeing where the excess carriers don't want to provide excess limits. So even if we can get it in the as a part of the general liability, or even a separate coverage line under the liability policy, we can't get excess over that coverage, or a much reduced limit on the excess. So that has been impacted, and more in California, I think, than in other states. Moving on to property. Property is very similar to, your homeowners or renters insurance. It is the buildings, it's your contents, if you're renting. Business income. Now, business income is something that nonprofits don't always think about as applying to them necessarily. But if you rent your building out to others, you could have a loss of rental income if there was a loss to the building. You could also lose funding if you're, for example, a school and you get funded by the number of students, average daily attendance, and you're shut down for a period of time. A business income can come into play in a lot of situations. So it is also the extra expense if you have to relocate to continue to provide services. So those are coverages that some nonprofits think that they don't necessarily need, but they likely need at least some of it. Inland marine is mobile property. I know it's a weird name, but inland marine covers things like your computers and laptops and things that you take off off your location. It can cover if you are a theater group and you have sets or property that you move from location to location. It can be so many examples of where property is not located at the premises, and the property policy will have a limitation to how far away from the premises the property can be to be covered as contents. And then that's when inland marine comes into play. Crime can be written as part of or is a property coverage. It can be written separate or as part of your property policy. This covers your employee dishonesty and fraud. We talk about it also as a separate coverage later on. Equipment breakdown is the coverages that could happen to the building that aren't necessarily normally covered, like a water boiler, a water heater exploding, some other types of equipment breakdown. Catastrophes, earthquake and flood, those coverages are almost always in California, written separate from the written separately from the regular property policy. Sometimes we can do earthquake sprinkler leakage covered as part of the property policy, but often if you need a regular full earthquake policy or flood policy, it has to be written separately. And if you're doing any construction, you would need to get builder's risk.
Good example of the property loss that includes business interruption would be an electrical fire at a school that damages the kitchen and the classrooms. And so you have a loss of revenue because you don't have students that are able to attend your school. And then also you have property damage because you need to replace, the kitchen and all of the equipment and business personal property, the contents. And
Yeah,
pricing
and
is oh, go ahead.
I was just going to say, pricing,
Okay.
as we all know in California, due to the catastrophes and wildfire and inflation, rebuilding costs is just skyrocketed, and it's hard to get. So. Automobile is so similar to your own automobile insurance that we do talk about it more from what is different. What's different is it's written on a commercial automobile policy, which has different wording and different who is an insured coverage. But one of the first coverages that most nonprofits do need to add is their hired and non-owned auto liability coverage. And those two little pieces of the auto policy can be written as part of the general liability sometimes. But the hired auto is when you're renting cars for the organization, and the non-owned auto is when your employees are using cars in the course of business for your organization.
This question
And
comes up a lot about
yeah.
I don't need non-owned auto, but this is really the sort of sleeping giant that can cause quite a bit of erosion on your insurance limits. So the way it works is that your employee, because they're driving their own vehicle, they are the ones that are in the accident, and assuming they're at fault, their insurance is primary. Many of your employees may not even be carrying limits that are higher limits. You know, they're carrying the minimum limits, which is 15,000 per person, 30,000 per accident, and like 5,000 in property damage. If the employee is in an accident large enough, like if you see this image here, and thanks to Copilot for helping me with all my images on the slides, but if there's injury to, let's just say it's the school bus, this employee hits a school bus, so we have people that are injured on the school, in the school bus, that employee's limits are going to be eroded immediately. What's going to happen is there's going to be a lawsuit because they're going to find out the employee was working for an organization, and then they're going to sue the organization. And then, so the employee's insurance is first, and then when it pierces those limits, it will go into the nonprofit's non-owned auto. It's insurance for those autos that they don't own. And if it is large enough, it can actually pierce the non-owned auto limits and then go up into the umbrella or excess liability. So even if you have someone that's running, errands to and from Staples or just out in the field, maybe visiting clients. This is a really important coverage to have on your policy. We don't normally see clients not have this, but many startups will consider that it's not something that they need. But if you have anyone driving, it's important to carry.
And the other unique coverage on here that's unique to nonprofits is the volunteers as insureds. And this is basically treating your volunteers as your employees as insureds under your organization. So they are covered by that non-owned auto liability. I will say that one of the largest, I used to work at a carrier and that specialized in nonprofits, and one of the largest auto claims that we had was a non-owned auto claim for a very small theater group in Marin County that had an part-time employee who was office assistant and ran errands for the office and picked things up and went here and there. So she needed her car for her work. And the court determined that made the organization liable even when she was on her way home from work and not on the clock and not working, not running an errand for the organization. She had a very bad accident, killed the other driver, and they ended up paying. Now, her own policy was through her parents, and her parents' policy paid about $1.2 million. And then our company paid another $2 million on top of that. So auto claims are, if you look at, there's an index that Travelers Insurance Company puts out of the largest verdicts in the country. A lot of those largest verdicts in the country are trucking and auto related. So.
And there's great questions that are coming up that we can answer at the end, and we have covered most of the slides that are intense in terms of explanation and coverage. We have just a few more slides to go through, and then we can answer the questions.
Yes, so the next coverage is umbrella and excess. Those terms are used interchangeably often, but they're not actually interchangeably. Carriers use them interchangeably and people use them interchangeably. But an umbrella policy means that it is over all your liability and could potentially drop down if there's a gap in coverage or a coverage that isn't going to pay, meaning instead of laying on top of all those coverages here, it would drop down. The difference is an excess liability policy purely is providing another layer of coverage above, and it isn't going to cover anything that isn't covered by the underlying policy. Umbrella policies and excess policies can have their own exclusions and terms in them. So, and that's true of both of them. So it could, for example, as we were talking about sexual abuse and molestation earlier, the umbrella policy, let's say that sexual abuse is written on the general liability policy, and you have another extra $1 million or $2 million on top of it in your umbrella policy. There could be an exclusion in your umbrella or excess policy that says we're over this policy, but not for sexual abuse. So they could actually exclude it out, even a coverage that's on the underlying policy. So it is important to look at those terms, and if they change over time, which we are seeing them change often. A lot of times nonprofits need to get an umbrella or excess policy to cover contractual requirements. And there is an often overlooked coverage, which doesn't cost anything from any of the carriers that I know of, is you can have your umbrella or excess liability go over the employer's liability portion of your workers' comp. So, workers' comp has two main components, which I think that's our next topic anyway, is to talk about those two areas. One is the employer's liability, and one is the statutory required coverages. And so you can have that coverage covered under your umbrella. However, you have to ask for it. And as I said, it usually doesn't cost extra money. Whereas other coverages, when you put them under there, are used as rating factors for how they determine what the cost of your umbrella or excess policy is going to be.
This is one reason why you would really prefer to have one broker manage all of your insurance policies, is because the umbrella is dropping down on policies. And if one broker doesn't handle all of them, they don't know about the other pieces that might be out there that need to be scheduled under the umbrella. For example, the employer's liability that's part of the workers' comp coverage.
And speaking of workers' comp, we listed this as our first statutory required coverage, and typically it is. As soon as you have an employee, a paid employee, you need to get workers' comp insurance. That is a requirement. You're subject to fines if you don't have it. It is required to protect your employees on the job from injury, illness, or death. There are two sections on the workers' compensation. One is the coverage direct coverages for the employee. These are their medical benefits, paying for their medical services, and their loss of wages. The second coverage, which applies to the employer, is the employer's liability section. And this is the part that you can cover. And this is for lawsuits. And it is, an additional layer for the employer, because they're, not to get too deep into workers' comp, but workers' comp is a sole remedy. So they can't sue under the general liability. So even if the employer is negligent in some other way, they can't sue under general liability. It has to be done through this workers' comp policy. We do see occasionally, we see volunteers covered under the workers' comp insurance. The issue with including volunteers is you have to come up with a wage equivalent for them, and it can be expensive, and not very many carriers offer it. We typically will recommend you consider an accident policy to cover your volunteers, because it's a lot more reasonable cost-wise. You don't have to come up with a value for their services. There are no exemptions or exclusions for employees of nonprofits. So no employee can be excluded from your workers' comp coverage. Like if you are a sole proprietor, you can exclude yourself from workers' comp coverage. You can't do that on a nonprofit policy, because the nonprofit is the entity and everyone else is an employee. This also means your board members, if you pay them, have to be covered by the workers' comp policy. Now, I know that isn't common, but some organizations will call it a stipend or some other term, and then you are subject to the minimum wages for the classifications of those directors. So even if they receive $1,000 a year, you're going to have to add them in at a salary of, I don't know what the minimum is. It would depend on the organization, but somewhere upwards of $35,000 or $40,000 as a minimum salary that you're paying for workers' comp for them. So board members cannot just be excluded. There are requirements for who can be excluded from a workers' comp policy, and nonprofits don't qualify for any of them. They can't be excluded because they can't be included unless they're paid.
It's 11:48 and we have 3 more slides.
Okay, we're going to go
This
super fast
says
so we have
cyber,
questions. Yeah.
yeah, and I'm answering them as they go along as
Okay.
well.
Well, there's a
Mhm.
lot of questions in the Q&A also. So,
Yeah, I'm answering that. Oh, okay, gotcha. Oh
okay.
gosh, yes. Okay.
So volunteer participant accident coverage is really can be coverage for your volunteers or your participants. It's accident coverage. It's typically excess over any medical insurance they have, but it can give you a little bit of protection against a claim being made against the medical payments on your general liability, as well as just covering some additional medical expenses. Lots of slip and falls of volunteers I've seen covered under this. We had an accident claim on one of our insureds who has had an outdoor day camp, and a kid got stung by a bee. They paid the medical bills for the participant under the participant liability. Cyber liability.
That's a good one.
Yeah. So, Robert, there we
Can I
go.
take this one?
Yeah, sure.
So cyber is a really hot topic. We even have, every month there's like breast cancer awareness month. There is a little in the insurance industry, there's cyber awareness month, which is October. And it is a critical component to any organization's risk management strategy. And really what it's doing is providing you the insurance, not to prevent you from getting hacked, or having ransomware or leaking information, but how do you respond to an incident? And so there are requirements in terms of notifying the local authorities if information has been breached. And this is non-public information. So if it's readily available, we're not talking about that, but we're talking about, for an example, if you're a clinic that has a lot of private information, medical information, and that information is somehow breached and exposed. So you need to notify the authorities. You need to notify those that were affected. You may even need to offer credit monitoring. There's also a PR related to, what kind of PR to help get in front of that situation to give everyone the peace of mind that, you are a company that they want to do business with. And so this cyber is all of those coverages or all of those expenses that you would incur from an event. It's providing the reimbursement for that or the payment for that. So it also includes, if the data has been damaged, if the system has been damaged, reputational damage. So all of the things that we're mentioning here, there are I don't want to say legitimate companies because they're illegitimate, but there are actually businesses out there trying to find ways into weak systems to either put ransom or shut down the system. And so this is why it's really critical to make sure that you have a good maintenance plan in terms of your technology and having strong passwords. But it's very easy it's a soft market right now in terms of the pricing for cyber, and it can be sometimes added, it's not very robust, but it could be added to one of your package policies for some reimbursement. Um, one example I was reading the other day was that there was a casino that was breached. Their high stakes poker room was breached, and the way they found into their system was through the Bluetooth setting on the aquarium that they had. So there was a Bluetooth um, thermometer and salinity, and so that whatever system that they used to get into that, whatever system they had in place for that monitoring that aquarium, the hackers were able to find through a weak password in there and then get able to get into the high stakes poker room. So I know you're not running any high stakes poker um, games, but those kinds of attempts are very costly to an organization.
Employee dishonesty, we talked a little bit, but this, the crime coverage includes employee dishonesty, but also include things like burglary, theft, social engineering, or phishing, which aren't always written when it's on a package. You have to get them separate. Social engineering, phishing can also be part of your cyber policy. And then we talked a little bit about some of the other coverages that you may need. Business travel accident is another kind of accident coverage that you can get for your employees if they are traveling on behalf of the organization frequently. A business travel policy can give accident coverage and services to your employees while they're traveling. Foreign liability, if you go to another country, running a mission in another country or doing activities in another country, you may need to get foreign liability, and that can include foreign workers' comp or an equivalent depending on the country that you're in. Special event insurance, if you're running events, need to make sure they're covered under your general liability, and if not, you may need to buy an extra special event policy. And then some organizations have bonds. So, why we're different. We're nonprofit owned. We're owned by the California Association of Nonprofits, CalNonprofits. And this is what we do. 98% of our clients are nonprofits. We do lots of also social service lookalike entities that aren't necessarily 501c nonprofits, but they are providing services similar to nonprofits, or they're providing adjacent services for profit to our nonprofits. So we have a passion,
do you want to talk about the fact that when clients work with us, how that goes back into the
So yeah, working with us supports all of the advocacy and support that you're getting from CalNonprofits legislatively, and the work that they do in the state and nationally to support nonprofits and that advocacy and change. Last year, we were able to give the association more than $1 million to support the work that they're doing on your behalf. So now I will open up the Q&A and see the questions that we have and how many we can get to in the next few minutes. So Robert asked, if a nonprofit has very little in the way of assets, why does it need insurance? You need insurance because the amount of your actual assets does not necessarily reflect what you may be asked to pay. Now, that means you could shut down, but you would have to stop providing whatever services you are providing. So you can certainly choose that. I would say that you may have trouble getting board members. I personally, I serve on a couple of nonprofit boards. I would not join a board that didn't have insurance. I do know that there was a question about the limits of insurance and what limits of insurance you should select. That is not something I could say, oh, you should have $1 million or you should have 2 million. Your board, as your governing body, is who should determine what limits you have and how that is going to affect your organization. And that can be based on a number of factors, including their what protection they feel they need as a board personally. So, yeah.
There's a question. I thought this was a good about, does the church need D&O insurance? I've been told that the nonprofit, this is coming from Robert, told that the nonprofit board member's personal property is protected by the nonprofit status, which is not correct.
Not that I know. I don't think a church is any different from any other nonprofit there, but I could be wrong on that. But
yeah, the way that D&O works is to transfer the fact that you no longer are personally liable because you have insurance to provide defense. Otherwise, you could be personally liable and your assets are at stake. I also put my email in the chat if anyone wants to send these questions that if we've not answered thoroughly or you want to talk further about that, the questions that you've posed.
I see a general question here from an anonymous attendee. As a broker, what do you do when a client or potential client is declined liability insurance from all of the A- or higher rated carriers.
Yeah, and that happens, especially we're seeing a lot more of that around social justice work and 501c4s too. So when we can't, we disclose that. And, I know Amy said like kind of a blanket statement at the beginning that we only place with that and above. But there are instances where we have to go, just like sometimes we have to go to non-admitted carriers that aren't admitted to do business in the state of California. That doesn't mean that they're not good carriers. It means that they aren't subject to the same regulation on their rates as admitted carriers are. And we have to jump through more hoops to write business with those carriers. So we do disclose that. We do talk about it. But there could be instances where that is that we have to do that. But we try. Another benefit of working with us as a broker is that we have all the nonprofit markets that are out there available to us. So there are a lot of brokers that only place with a handful of the companies that will write nonprofits, and we do business with all of them.
I see
That's a
another
good,
question
thanks
here.
for good clarification about the non-admitted.
It is. It's super helpful. There's another question here that's been thumbs up by a couple of folks. And so I thought I'd ask that. Do 1099 contractors need to be covered by workers' comp?
So there are very few instances where someone actually qualifies as a 1099 contractor. So we would ask, we did a webinar a few years back about AB5 and the changes to the testing for whether someone can actually be considered a 1099. I will say that if they don't pass all the tests, the workers' comp carrier will count them in your payroll and cover them, whether you want to or not. So that's something to keep in mind. We are setting up our webinars for next year, and I think we're doing one all on workers' comp. And so that one we will dive in depth. As I said, most of these topics we could talk an entire hour on. And we had to stay at the 10,000 foot level to get to where we are right now, which I know we're at time, but I think the recording might still be available on the CalNonprofits website about that old webinar on the independent contractor situation, especially in California, is different. So,
thank you, Colleen and Amy. I know we do have some questions that we didn't get to answer, but I would invite you to reach out to Colleen and Amy. I will be sending a recording of this event, as well as all of the slides, their contact information, and a copy of our most recent past event with CNIS that speaks to some of the questions that were asked in the Q&A. And as Colleen mentioned, we do have 3 upcoming webinars with CNIS over the course of the 2026 calendar year. So there'll be plenty more time for you to engage with CNIS, and also do feel free to reach out to them. They're more than happy to speak with you. And a lot of these questions are really dependent on your individual circumstances. So having a conversation with someone like Colleen or Amy, I think would be really helpful. But
and Robert, you're sending us all the questions too, right? So
I certainly am.
If you're not anonymous, Amy will be reaching out to you to answer your question.
Great.
Absolutely. Thank you so much. Thanks for joining.
Thank you to Amy and Colleen for sharing your expertise with our community and breaking down some of the basics of insurance. Like you said, I know we could talk for hours on this, and in the upcoming months we will. So stay tuned for more events from CalNonprofits and CNIS.